Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Robert of Infranomics. Robert, how are you this morning?
Good. How are you?
Doing very well, thank you very much. Take two because of a couple of internet issues my end. And before we get cracking on, just a big thank you to Roberto Rios, aka the Peruvian Bull, because he was one that put us in touch and said you guys need to have a conversation about mainly the silent depression. And if you can, Robert, let's start there because a lot's going on in the background, but you're quite well known for the silent depression. So for those that might not know what that is, what is it and what does it entail?
Yeah, so it started a couple years ago. I was noticing a disparity between headline economic data that was being reported, which of course they were saying was quite strong, compared to kind of my experience, my friends' experience, what I was noticing, especially from young people on anecdotal experience of mainly young people, that things have never really been worse than this. And so I wanted to start kind of looking into what that disparity was all about. Why are there two, and of course, now we call it the K-shaped economy, but kind of along those lines, what's going on here? And so one of the things that I try to do is look at economic data, not in the traditional headline nominal, right? Average hourly wage up and to the right. I try to figure out ways to use the right denominator, which I think is critical, especially in an era where the denominator, aka the dollar, is slowly but surely breaking. It's important to find different denominators that more accurately reflect some of these some of the purchasing power of average hourly wage, which
Mhm.
in gold terms peaked in the late 90s, early 2000s. So what I kept coming to, looking at hundreds of data points and looking at them relative to other things, relative to gold, relative to the M2 money supply, I kept coming back to this late 90s, early 2000s peak in many metrics. At first, it was just like two or three, and I thought, oh, this is just a coincidence. But then, kind of, the more that I kept digging, the more that I found, oh no, this is like everything was peaking then if you use the right denominator. So, labor force participation rate peaked in the late 90s, early 2000s. I'll just say 2000s. Labor force participation rate, real personal income, so personal income divided by the M2 money supply, the average hourly wage in gold terms, real S&P 500, so S&P 500 in gold terms. All of these metrics were peaking and then declining for the past 25 years, which I entered the labor force as an adult. I'm a young millennial. I did that like 2 months after I got my first job, about 2 months after Lehman collapsed. I mean, it was like collapsing when I was going in for
Mhm.
the interview. So, yeah, so and I felt something definitely change even in that short period of time following 2020. And I think a lot of people have, kind of zoomed in on that particular portion of time and the distortions caused by the immense fiscal and monetary stimulus from 2020 onward. But what I kept coming back to is no, a lot of this started actually before that, 20 years before that, and yeah, and have been in decline ever since. And I think it's just really critical for people to understand that like the headline numbers that get reported, especially if it's a nominal number, but even when they use real, right? When they talk about real wages, real personal spending, they're using a broken denominator. They're using a CPI, which I think most normal people can admit is fundamentally broken with all the substitutions and heuristics. And
Mhm.
so like I just, yeah, I think it's really critical to use proper denominators that accurately reflect certain things, right? If you're trying to look at the average hourly wage, well, we know CPI is broken. Well, what determines inflation? What determines the purchasing power and reflects currency debasement, monetary expansion? Well, gold over an hour, a day, a week. Okay, it's not an accurate measuring stick for currency debasement or monetary expansion, but over years, certainly decades, It's a very useful and accurate way to measure monetary debasement. So try switching the denominator from this dollar, which is kind of what we're brainwashed or conditioned, better word, conditioned to look at the world through. Let's start using other denominators that are more reflective of the actual effect of, say, expansion of the M2 money supply. And so once you start to do that and look at it through the proper lens, paints a very different picture from kind of what the traditional regime power center type folks would like to have you believe, which is America peaked in the late 90s and really has been in decline. I mean, another one that is, I think, critical is what are called deaths of despair. So this is something that I always mention because I think it's a tragedy. Uh, Following the China shock, where China was admitted into the World Trade Organization, deaths of despair just went parabolic, like on the year, to a point. 2000, 2001, they just start going vertical. And of course, globalization started before that. You look at the trade deficit or the balance of trade for the US, it really started in kind of the early to mid 80s. But the acceleration of that offshoring really kind of took off with the China shock. I would mark that as really a major turning point. Was that China shock? And when you look at, when you think about America and kind of what America used to be and what the American dream and American exceptionalism and all these kind of concepts and themes, it used to be that, back in my parents' grandparents' era, one person, only one income was needed. If about 70% of Americans don't have a college degree, and so those jobs that those Americans would get, the majority of Americans, would be manufacturing. Well, we decided to offshore all of those well-paying jobs. Again, you could support a family on one single income. There was not this dual income household thing. And we decided, our policymakers, both parties, by the way, decided to ship all those jobs to overseas to emerging markets like China, in really the effort of boosting corporate profit margins and boosting the nominal return of financial assets. And they were very successful in doing that. When you're running about $150 billion per month current account deficit, what that requires is about $150 billion inflow per month into financial assets. So, the top 1%, this is that K-shaped economy. It really started much sooner than 2020. It goes way further back than that. Who holds all the assets? We know the top 10% of households own 91% of household equity exposure. We know it's the wealthy that hold all the assets, and they benefit massively from not only the corporate on the corporate side, right? Corporations are boosting profit margins by offshoring to cheaper labor sources, but not only that, but because their margins expand, the things like the S&P 500 or the stock market have done very, very well. Well, who owns all of those assets? It's the top 1%, the top 10%. So you really saw kind of the effect of globalization. And I would argue we've reached peak globalization. And my hope, my cautious optimism, is that will start to reverse, and therefore some of these silent depression metrics, right? Like, for example, in 2000, the average hour of work, you would get 0.09 ounces of gold. Well, today it hit an all-time low, going back 70 years, hit an all-time low of 0.01 ounces. So that is a massive decline in real purchasing power of the average hourly wage. And I hope that since the pendulum swung and we kind of reached peak globalism, my hope is, as that pendulum starts to kind of swing back, maybe some of these kind of real metrics indicating the health of the average American could hopefully start to improve. Now, there's a number of headwinds. AI, robotics, productivity came in very, very hot this past week or two. So, there are headwinds to that, and the incentives of the structure of the system and the structure of the system, is rigged against an improvement for the bottom 90%. We have, it's all kind of broken pretty badly. So, there's certainly a lot of headwinds for a reversal of these trends, But, I think there's reason, maybe just a couple reasons, not a lot of reasons, but there's a few reasons I think to be optimistic that some of these might start to improve.
Just to go back to deaths of despair, although it might be quite obvious to most people listening to this, can you just explain what a death of despair is for those that might not know?
Yeah, so it's alcohol related death, drug overdose plus suicide. And it's a sociological term that sociologists came up with. And again, the origin of the term is not just in the past couple of years. Like this has been something that sociologists at least have studied. And yeah, I would encourage folks to just search that term. There's tons of data, tons of good academic research that shows just an explosion. Deaths of despair today in the U.S. are double the rate that they were during the Great Depression. Double.
Wow, I didn't know that. That's mind-boggling, I think is the first word that comes to mind there, Robert, I have to say. Okay, so all of that being said, so in a nutshell, people are basically getting fed the wrong data points, and maybe the data's being massaged to make things look better than it actually is. And you're saying, well, hang on a minute, all of this really goes back to, the late 90s, 2000s, so it's been going on for quite a while. So in that case, what is the current trajectory? Is it just going to continue to play out as it is with everything you said, or are there other forces at play from your analysis and research?
Yeah, so I think globalization and a reversal of these pretty insane trade deficits, current account deficits, I think that is a massively misunderstood or underappreciated dynamic for a lot of the K-shaped economy, a lot of this kind of silent depression stuff. I mean, we're talking about $150 billion per month, 450 billion current account deficit per quarter, the last quarter, and that works out to $150 billion per month that mechanically, on a balance of payments basis, must flow into financial assets. So, imagine you have a $150 billion structural price insensitive bid. And this is affecting the housing market, for example. Again, kind of a massively underappreciated dynamic is that these foreign buyers, and you can find the data under foreign direct investment from the BEA reports, you can find this data. Those foreign investors are price insensitive. Now, that is in stark contrast to even the private equity, even Blackstone and, some of those private equity firms that a lot of people blame for high housing. And look, there's certainly a big issue there that should be addressed. But that foreign buyer is price insensitive. At least Blackstone to some degree is price sensitive to some degree. And so, yeah, so I think that, and this affects not only housing and real estate, but also equities, right? And then also U.S. Treasury. So you get into the implications of balancing trade. And, I thought it was really notable when they said, this was months ago, kind of early on in the administration, when they said, and I forget who exactly it was. I don't think it was Besant, but one of the key cabinet members said the goal is not to reduce the trade deficit. The goal is to eliminate the trade deficit. Well, there's many implications there. Number one, that trade deficit is how we export dollars to the rest of the world. Number one. Number two, you're removing that, call it $100 billion per month bid into the financial assets that have just utterly ran away from the average American. I mean, part of what the boomers had was the ability to invest their money and grow their capital. If you look, for example, at the S&P 500 in average hourly wage terms, right? So how many hours of the average work does it take to get 1 unit of the S&P 500? That number's gone from 15 back in the 70s to 200, meaning you must work 200 hours to get 1 share of the S&P 500, about 200, whereas the boomers, it was about 15. Right. So put another way, the S&P 500 financial assets have grossly outpaced things like the average hourly wage. So balancing that trade deficit, I think, is a step in the right direction. At the end of the day, the issue with the U.S. at its very core is that by nature of being a twin deficit nation, we are net unproductive. So the only thing that the US kind of on a net basis can accumulate is debt. We are net unproductive. And I think that, trying to address that core issue of the fact that we are on a net basis, net unproductive, I think that is really one of the core issues. Any attempt to address that, I think, is a step in the right direction. But once you start kind of taking it a couple steps further, right? Okay, we're going to balance trade. Okay, well, that means the mechanism by which we were exporting dollars to the rest of the world, that mechanism is gone. So the whole Triffin dilemma, reserve currency, okay, that calls that into question. What does that mean for a dollar that's valued on a balance of payments basis rather than on this kind of structurally overvalued bizarro world that we found ourselves in? There's a lot of, kind of interesting conclusions when you play that out. But I think that, look, I think there is an appetite. I mean, I will point out and remind people, I'm old enough to remember that back in the late 90s, early 2000s, it was the left, it was Democrats here in the US that were opposed to these globalist trade ideals and kind of ideology. They accurately predicted what it would do to American wages. They should be taking a victory lap. They also warned what it would do to wealth inequality. The capital and financial account surplus or inflows. This is not a new or complicated phenomenon. Like, this is, balance of payments 101. So, the left was accurate in their warnings or their predictions of what this would do. And so what I think, we clearly see this kind of populist rising on the right with MAGA. I think that gets even more populist. But then I think that there's a very real possibility that we see that old left wing start to make a reemergence. When it comes to running a massive trade deficit. They might talk about it in different ways. They're probably not going to say the rest of the world is ripping us off. They're not going to frame it in the same way. They'll frame it centered on the average worker. But I think that, yeah, and look, not just in the US either. I think it was Keir Starmer recently said that, like, globalism failed the average Brit. Um, and so, yeah, so this is happening kind of all over the world and all over the West, right? And then you add into that China, CCP officials from within China for many years, like 5 years, have been talking about a need to restructure their economy away from this kind of subsidized export dumping overcapacity sort of approach into more domestic consumption. So I think that the pendulum, in terms of that kind of globalization to mercantilist or nationalist economics, I think that we peaked over here at the globalist side. And I think that I don't think that we're going to see a reacceleration there where it starts going back in that direction. I think that the pendulum is going to swing for the next decade, the next 2 decades. It's very inflationary. There are a lot of consequences there. It's probably not good for financial assets, kind of go down the list. But yeah, no, I mean, I do, again, cautious optimism. I think that the next decade is going to be very volatile. I think it's going to be very inflationary, very tumultuous. But I do think that in the end, we come out of this in a stronger position. That is my hope as an American. All my criticisms of American economic policy, trade policy, monetary policy are solely rooted on the fact that I hate seeing 90,000 young men totally disaffected, killing themselves, overdosing on drugs. I hate seeing a suicide rate that hasn't been this high, suicide rate that hasn't been this high since the Great Depression. Our young people are just not okay. And so my hope is that, it's not going to be easy. It's not going to be quick. And it's not going to be without pretty significant inflation, in my view. So, it's not to say that this is going to be easy or quick, but I do think that, in the end, say 10, 20 years down the line, I do think that a lot of these things hopefully improve.
Fingers crossed on that. I agree with you on that. First of all, in terms of Keir Starmer saying things that haven't benefited the British people. I will not go down that route because I could speak for hours about how he's probably done a lot more damage himself. Secondly, you mentioned Triffin's dilemma, and again, one of the things I really like about your work, Robert, is you simplifying things, put it into layman's terms. I like doing the same. So again, just for people that might not be aware of what Triffin's dilemma is and what it entails, can you just dive into that, please?
Yeah, so Triffin, Robert Triffin was a Belgian economist, Belgian American economist, and back in the early '60s, there was a report commissioned to evaluate kind of the economic state of things. He was one of many contributors to that report. I would recommend people read that report if they're a nerd like I am. It's quite interesting. But Triffin is well known for Triffin dilemma, which is kind of a concept or a paradox that he proposed back then in the early '60s, which is that by being the reserve currency issuer of the world, you must run trade deficits. That is how you supply the dollars that everyone else in the world needs. You must run large trade deficits in order to get, that is the transmission mechanism to get the dollars to the foreigners. Well, by running ever larger trade deficits, you run ever larger capital and financial account surpluses, meaning if you're a Chinese person, and anyone around the world that wants to be in the dollar, say you're in Europe, due to the fact that the dollar is or was certainly the reserve currency, what the order of operations, you must sell your euro to buy the dollar to then buy the dollar denominated asset, such as a US Treasury or US stocks or real estate. So what you get is an ever strengthening a dollar. And now that might sound good to the average American that might not be a macro nerd. That might sound good. A strong dollar sounds good. The problem is that an overvalued currency or a strong dollar, yes, it makes imports very cheap. This is part of why we can go on Alibaba and get, a $200 TV that used to cost, the strength of the dollar, especially relative to the yuan, allows imports to be quite cheap. The downside is that if you make things here in America, your competitiveness on the global stage is quite diminished. So if you actually manufacture real things, and it can even be services to some degree too, we do have a services surplus, a slight one, but things made in America sold to the rest of the world are just utterly cost prohibitive. It makes no sense for the rest of the world to buy any of our things. So as that dollar continues to strengthen, you have the trade deficit get worse and worse and worse. And it's kind of a reflexive loop because, again, as the trade deficit gets worse, capital and financial account surplus must match on a balance of payments basis. You get a too strong of a currency, which ends up hollowing out your middle class, hollowing out your industrial base, and got to a point that we basically lost a proxy war to a country with 1/12 of our GDP because we just can't manufacture things anymore. We rely on our adversary, or at the very least, right, competitor. We rely on them for 65% of active pharmaceutical ingredients that our people need to survive, just at a bare minimum. I mean, people hopefully remember 2020, where it was impossible to get just basic personal protective equipment because we can't make anything in America anymore. Not only that, but all the electronic components that go into the modern kind of industrial, modern defense systems that we have, we rely on China for. And look, we basically sold out our industrial capacity so that China could buy Nvidia at a 45 price to earnings ratio so that they would buy our debt. And look, this kept interest rates low, right? When you have that a dollar reserves status. And when people say dollar, I think it's important for people to remember this is not dollar bills. It's not stacks of $100 bills. When people talk about the dollar as reserve currency, they're talking about interest bearing dollars. A treasury, especially a short-term treasury, is basically a dollar with interest. So that is really kind of the dollar as reserve currency or reserve asset. But that trend peaked in 2012, just as Triffin predicted. You get to this spot where you can't keep going on like this, right? Your industrial base is completely hollowed out. You've lost the ability to manufacture anything. Your dollar has become so overvalued. And I'll point out 2024, the DXY at called 105 on a purchasing power parity basis was actually even more overvalued than it was at the height of 1985 before the Plaza Accord.
Wow.
So yeah, you get to a spot where it's just not working anymore. You can't continue like this. And this is, this gets into Stephen Myron and the paper he wrote and kind of the Mar-a-Lago Accord and all of that. But that you get to the spot where you can't continue. Something has to be done. And of course, there's second and third order effects, wealth inequality, domestic political polarization, and all of that. So yeah, you get to a spot where you have to address it, and I would argue we're there.
Robert, I know you just mentioned it yourself, and I should have mentioned it at the start because the other thing that you're very well known for is calling the Mar-a-Lago, sorry, Accord quite early. So you might as well continue with that. So again, what is it? What's likely to happen with that moving forward, and how's that going to change the shape of the world?
Yeah, so it came in July of 24. I watched a speech that Scott Bessent gave. And of course, this was July of 24. This was months before the election. I watched a speech that he gave at the Manhattan Institute. And I would highly recommend people go, you can find it on YouTube. Scott Bessent, Manhattan Institute. He gave this speech. It was about an hour long. And within that hour, he mentioned the term global monetary reordering or something analogous, like two or three times. And not only that, but he said, and I want to be a part of it. And this was coming at a time where, I'd put out my post on my article on a dollar Dutch disease, which is kind of a related concept to Triffin's dilemma. I'd put that out. I was doing a lot of work on the dollar and kind of the structure of the global dollar system and that sort of thing. And so, by that point, I kind of was already coming to the conclusion, like, I don't think we're going to fix this gradually. I don't think that there is a natural market force to fix the fact that the dollar is so grossly overvalued and the yuan is so grossly undervalued. It's not just the yuan either. This is the case with, say, the yen, which I think on a purchasing power parity basis, fair value is like 110, I think, if memory serves. So, it's not just the yuan, but of course, bilateral trading partner being the largest, that's kind of, what I was zeroing in on. And I realized, right, like in the US, you have the dollar broken to the upside with all of the kind of dollar reserve mechanics and the euro dollar system and all these sorts of things. But then on the other side, you have a state managed economy with the CCP in China and a managed currency. They manage it to be weak so that they can continue to gain market share and export dump their way to global dominance. So, I realize like the free market has no answer to this, kind of thing. And that the free market response, which I generally hope for a free market response. I generally think a free market response is the best, generally. But like with this particular issue, I noticed there is no free market answer. And I was pressing some of the kind of libertarian, free market maximalist type people. No one could give me a coherent answer how to address this particular issue. So I came to a conclusion, like, you got to do a Plaza Accord. And so I started talking about it kind of before it had the name Mar-a-Lago Accord, which came, I think, in like October, was when that term kind of came about. But it was clear to me before that, listening to Scott Bessent with the Manhattan Institute, and all the work that I had done kind of on the dollar and Dutch disease, Triffin dilemma, and some of these issues, it was clear before that that there, that is kind of the inevitable conclusion or the inevitable solution to solving this issue. I would say that it's probably possible to, without a Mar-a-Lago Accord, without a currency accord, is probably possible to, over time, we're talking like 2 decades, maybe 3 decades, to start to address some of these issues. As we see gold become, and my hope is eventually Bitcoin, maybe a decade later, as we see gold rising as share of FX reserves, If that continues and we continue to see a decline in the dollar, which, by the way, foreign held debt as a share of US government debt, gross debt, that peaked over 12 years ago. So some of these things are already well into in effect. And if you see gold and neutral scarce bear assets start to gain share of net settlement, basically within global trade, maybe over 20, 30 years, you see a correction on a balance of currencies become more valued on a balance of payments basis. Kind of every year, marginally, as gold is used more and more, you could theoretically see it without a Mar-a-Lago Accord, without a currency accord. But the way, Luke Roman has talked about this a lot. I've had a couple back and forths with him on like how exactly do they do it. Like we both, I think, are in 100% agreement on the issue and then the kind of solution of this Mar-a-Lago Accord. But I was like, but how do they do it? Do they basically all fiat currencies have to be devalued versus real scarce assets? The debt in the developed world is just insane. It's not just the US, it's China, Japan, Europe, right? You go down the list. So basically, every fiat currency needs to be devalued. The debt needs to be devalued in real terms. And the conclusion that Luke and I kind of came to, I think, simultaneously was like, you could theoretically, if you were the Chinese, devalue the yuan by say 10%. Well, if you devalue the dollar by 50% against gold, you have effectively set a new exchange rate between the dollar yuan. And so basically that gold would likely be used as a pivot point to essentially set a new FX cross. And of course, look, like this, there's a number of implications for this again, it'll be quite tumultuous, I think, to have a fairly valued dollar. Imports, of course, will be very expensive because the dollar on a balance of payments basis is grossly overvalued. But eventually, again, kind of that 10, 20-year plan I was referring to earlier, eventually you see a rise, hopefully, in you see a trend change from this twin deficit, net unproductive country of the US, this hyper financialized mess of an economy, this K-shaped economy, a transition into one that is net productive. Much like China or Japan. I mean, I tell Americans, that there are countries that instead of accumulating debt, they accumulate national savings, and it like blows their mind. But I think that transition, it'll be very inflationary in my view. It'll be very tumultuous. It'll also not be very, very quick. This is going to take many, many years. I mean, when it comes to Trump and the tariffs and reindustrialization, this is not a 1 or 2 or 3 year thing. This is a 10 or 15-year thing. And again, my hope is that if the pendulum swings to the other party in 28, my hope is that they continue the push in the direction that Trump started. And so, yeah, I think, it's inflationary, but eventually you get to a point where you're not relying on your enemy for critical minerals, pharmaceuticals, protective equipment, electronics, and you're able to produce things at home. Now, when it comes to manufacturing jobs coming back, we've lost over 5 million in the past 25 years. I agree with the skeptics that those 5 million jobs are not coming back. I do think two things. I do think some will come back and they'll be well paying, and they'll be available for those high school educated, right, that don't have a college degree. There will be some, but even if there's only 1 million, you're still, from a national security perspective, you are still reshoring critical industry back to your country, which I think is really, even if only 1 million jobs come back or 800,000, you're still reshoring critical manufacturing back to your country. And I think that is a win. You're also addressing the net international investment position. I point out all the time that, the US is essentially not really that sovereign of a country. In early April, the bond market, maybe $50 billion of bond sales, US Treasury sales, were able to force Trump to capitulate on his core policy proposition of tariffs. $50 billion was able to force the president of the United States of America to capitulate on his core policy, agenda item of tariffs. So with a NIP of negative 95% of GDP, I would argue that's also a national security threat. And to some degree, the U.S. has lost sovereignty because of that. Again, decades of kind of accumulated deficits.
So, Robert, just before we wrap up, and I'm thinking, obviously, there's a whole range of people that are going to be listening to this, high net worth investors, individuals, people that are trying to figure out what they need to do in order to help themselves move forward. I know you've highlighted there's a lot of, should we say, challenges in the world at the moment, and things that have started 20 years ago and what's likely coming down the road as well. So apart from following yourself on X and YouTube, and again, I'll link to that in the post as well, what could people do in order to either, number one, help protect themselves moving forwards, but secondly, to become more alert about what's going on? Because I think we could all agree we're being fed even more BS by the day. So what can people do to sort all of that stuff out and get some clarity moving forward?
Yeah, clarity, I think, is a harder question. I think that, following folks that present a non-consensus or controversial opinions, I try to listen to everyone, even people that I pretty vehemently disagree with. I think that a return to critical thinking, just kind of broadly speaking, a return to open-mindedness and critical thinking. I think that will be critical for not only society but investors, of course, too. And then when it comes to like how I see in terms of like an asset allocation perspective, it would seem to me that the really like every time I try to answer that question in my own head, I keep coming back to scarcity. You want to own scarce bearer assets. Like I don't think that equities at record high valuations as we're recording, I don't think that equities that are largely concentrated in just, 5 or 6 names, record high valuations. Again, you can look at the equity market as a savings account to outpace inflation, sure, but like at the end of the day, you're still buying equity, which still discounted future cash flow, and the premium on that future cash flow is still insane. So, like, I don't really like equities. That's not to say they can't go higher in U.S. dollar terms, because it's pretty hard to bet against a nominal US dollar decline, nominal decline in dollar
Mm.
terms. But I think in gold terms, that's a different story. I like gold and Bitcoin. I think that, Bitcoin is surely a newer asset. It's surely higher risk. I would not, for example, recommend to my family to buy Bitcoin, right? They're boomers and nearing retirement. But I do think that things like gold, for that cohort, I've been very bullish gold going back to 22, 23, and I'm still very bullish gold. That is kind of but if you're younger, like myself, I'm a younger millennial. I don't own a home. So real estate, I think is a decent store value. Now it's hard to buy it here when everyone is calling for a crash. Personally, I'm not 100% convinced there will be a crash, nationally speaking. But real estate, generally speaking, is a relatively good, relatively scarce store value. When you look at the average home price divided by gold, it's a different story. It's almost an all-time low in gold terms. So, in real terms, again, it keeps coming back to gold. And I'll point out that like the S&P 500, the last time the U.S. had a protracted period of populism was 65 to 82. If you look at the S&P 500 divided by gold from 65 to 82, it declined by like 85%. So again, I really like gold. And I think that Bitcoin, if you have a higher risk tolerance like myself, because I'm young and kind of have to get ahead, crawl out of the hole that has been dug the past 25 years, certainly the past 5 years, I think that Bitcoin, it right now it's levered Nasdaq. Right now it's high beta Nasdaq for sure. I agree with that kind of characterization, but I do think that like around the margins, over the next decade or two, the scarcity of Bitcoin, I'll point out, it's more scarce than gold. It's more portable, more divisible, more verifiable. So there are, fundamental reasons for liking Bitcoin over the next decade or two. I think that again, as sovereigns, especially those current account surplus sovereigns, look to a way to store their value, the value of the surpluses that they generate, as they look for the alternative to the dollar or the treasury. I think that gold certainly over the past decade or so has started to rise quite dramatically in terms of gold. But I think that maybe around the margins you start to see a little bit of Bitcoin, even if it's only 5%. I mean, Bitcoin's much smaller market, so in my opinion, it has much more room to the upside. It's more scarce. So I like Bitcoin, but I also really like gold. And if I had the ability to own real estate, if it, that would probably be number three on the list in terms of. But you want the antidote to volatility is bearer
Mm.
asset. The antidote to increasing authoritarianism is bearer asset. The antidote to overabundance of currency units related to the fiscal kind of nightmare that the developed world is in, the scarcity is scarcity, right? The antidote to that is scarcity. So I think that, yeah, I think that bonds. I would not want to be in bonds, well, at all, especially long dated bonds, duration. So I wouldn't want to be in that. And again, equities, again, like at record high valuation, here and there, you'll see an opportunity. I really liked UNH kind of on that dip. I didn't actually buy any. I'm kicking myself because I knew it was the right move. But you'll see, single names here and there that could present good opportunities. But I think generally speaking, we're in for more volatility, more inflation, and more increasing tension, strife, both domestically and internationally. And so, yeah, Bitcoin, you can store 12 words in your head, transport those across borders. God forbid you ever have to do that. So yeah, I hopefully that makes sense. Kind of my line of thinking for gold and Bitcoin at least.
Yeah, it definitely does make sense to me, and I'm sure it's going to make sense to everyone listening as well. So in effect, we've got depending on where you are in your life with savings and so forth, possibly a blend of Bitcoin and gold, if not a bit of Bitcoin and maybe no gold or vice versa. Ideally, a bit of both, and then land as well. Well, Robert, we could probably talk for hours, and I've learned a lot, so I've got a lot of mental notes I need to make. As a result of this recording, but just so people have the ability to find you and connect with you. Again, I'll do all these links in the show notes. How do people get in touch and follow your work?
Yeah, so I'm kind of focusing my effort right now on a YouTube. I just started it like 4 or 5 months ago. It's doing quite well, so I'm kind of using that as an indicator. Okay, focus on this. And so it seems to be resonating. It seems to be helpful, educational for people, which is really kind of my sole primary goal with that. And that YouTube is Infranomics, INFRA nomics, economics, Infranomics on YouTube. And then on Twitter, on X, it's at infra, INFRAA underscore. And I do still participate there. I do some Twitter spaces or X spaces, and do post some thoughts there as well. And that's generally where people communicate best with me if you want to send a DM or something like that.
Perfect. As mentioned, I'll put the links in the notes as well. I highly recommend people go and check out your YouTube. I sat and watched a few videos in preparation for this, and the way that you explain things, very, very good, very articulate. So keep up the great work, basically, Robert. Look forward to catching up again in 2026.
Yeah, thanks for having me. It was great.